In this video, I'm going to be combining my trades from week 6 and 7 of the funded challenge. I'm having trouble with MetaTrader 5. It's not opening, so I'm going to show everything from the Blue Guardian dashboard. For this challenge, the total loss allowed is $2,000, and as you can see, we've reached 57% of that amount. So overall, we're at a loss at $1,136.99. Here we could see that the current balance of the account is $23,863.01. My win rate is 28%. There are definitely a lot of emotional trades that affected this win rate because of a low win rate, as well as being in drawdown pretty much the whole challenge, made me take a step back and really review my current trading plan and strategy. And I came to some really important takeaways, which I'll share in a bit. But just scrolling down to the trades that I took. The trades from week 7 start here on the 17th, where we see that I took 2 losses. On the 18th, I took 3 trades, 1 partial win and 2 losses. On the 19th, I had a very emotional day. As you can see, I overtraded. There's a mix of different wins and losses here, which I'll talk about during the analysis. On the 20th here, we see I took 3 trades, 1 loss, and 2 wins. The trades for week 7 start here, and I didn't win a single trade in week 7. So I was at a loss the entire week. In total, from week 6, I was down $69.63. In week 7, overall, I was down $414.53. So being overall in the red and having such a low win rate, it forced me to review my current plan and strategy. And there was one important realization that I had. The realization was that my current trading strategy is not specific enough for me when it comes to the entry and the bias. Currently with my strategy, it's either a 3-minute or a 5-minute market structure shift, followed by a fair value gap or breaker block on the 3 or 5-minute time frame. I've come to realize that this is too many entries to choose from for me. The takeaway here is to focus on a specific entry. And just an example here, I should only take a trade when I see a 5-minute market structure shift and a breaker block fair value gap overlap. And so that is an ICT unicorn entry. There should be a sweep before the market structure shift as well, but this reduces the number of entries that I'm looking for, and it's pretty strict because if there is no 5-minute unicorn, there is no trade. And so this is one of the things that I'm going to be working on refining, is just focusing on a specific entry. I'm also probably going to get rid of the 3-minute time frame and only focus on the 5-minute. The entry that I'm going to be looking at and back testing next week is probably going to have some form of this breaker block and displacement. Another thing is that I don't have any clear rules when it comes to determining bias. Currently, I'm using a mix of candle range theory as well as external to internal liquidity, while also keeping in mind the market maker buy and sell model. And so that's a lot going on at once. Wouldn't be surprised if it was overcomplicating my trading. The takeaway here is to choose one method for determining bias and stick with it. I'm going to be choosing between candle range theory, external to internal liquidity, or using the market maker buy and sell model of a specific time frame. Personally, I'm leaning more towards using the market maker buy and sell model. Not sure what time frame that's going to be, but once I determine that, that's the only method I'm going to use to determine the bias. Like, yes, be aware of external and internal liquidity on the higher time frames, but I really should be trading in line with the market maker buy or sell model of the time frame that I choose. So that's another thing that I'm going to be back testing and refining next week. If you've been following me throughout this challenge, you know that emotions have been a struggle for me. And so I decided to take some active steps to confront this. Once I finalize the rules for my strategy and make them very specific, I'm going to create a checklist and physically check off each requirement before placing a trade. So this will force me to actually read the requirement and physically check off that it fits my rules. So hopefully this could help me take a step back if I start thinking a bit emotionally. The other thing is to start filming while I'm trading. Right now, I film the analysis after I take the trades. I think I'm going to start filming myself while I'm trading, talk through the analysis, and then film myself while I place it. This is to hold myself accountable to make sure I'm following my rules, but also to be helpful to you guys to see what I'm looking for in real time as I enter the markets. I think it'll be especially helpful once this trading plan and strategy is refined, so you can see me following the rules and checking off the checklist every time I make a trade. It'll hopefully accomplish two things. One, make me less emotional, but two, also help you guys understand how I'm going about looking at the markets and analyzing them. So with that, I'm going to take next week off from the funded challenge for Forex to finalize these rules and update my trading plan. Then the week after will be when I start this new video format. Because I've reached more than half of the max loss allowed, I'm going to reduce my risk when I start trading again to 0.125%. That's the plan for me. I'm also paper trading MNQ. I'm using a different strategy for that. I'm actually utilizing ICT's 2024 model. I'm still working on getting used to futures and how MNQ moves. I'm going to be doing that next week. That's the plan moving forward. Now that I've covered that, I can go ahead and move over to the trade analysis. Because there was a good variety of trades over the past 2 weeks, to be efficient with the analysis, I'm going to be going over my thought process for trades that I feel were well executed. And then for trades that weren't, I'll go over the important takeaways and learnings from those trades. So starting with the trades from September 17th, this is what I saw coming into the market. So I marked out the previous day highs and lows as well as the Friday highs and lows. Because price had just swept this external liquidity, this daily low, price was now seeking internal liquidity. And we can see here that it filled this internal liquidity and is now seeking external liquidity. The external liquidity that I had marked as the potential target was the daily swing high here. Also, there was strong bullish momentum. As you can see, on Monday, price swept and closed above the Friday high. Because of the strong bullish momentum, this daily swing high here for price to take, my overall bias was bullish. Switching to the layout where I actually charted for this trade. So I used the bar replay tool to clean it up a bit. So I'm not sure why the position tool isn't showing, but it does show on the 5-minute, which I'll drop to in a second. But just talking through what was going through my mind here, did see that we had a sweep of liquidity followed by a strong move up, leaving behind this fair value gap and inverse fair value gap here. Seeing that, watching price, I did see price sweep 15-minute liquidity into this fair value gap. And so after I saw this, I saw a market structure shift here on the 5-minute chart and entered at the 5-minute breaker block, targeting this London high. After losing this trade, I wanted to re-enter, so I re-entered here. After price swept this liquidity further down, as you can see, price stopped me out. And so just takeaway here and zooming out, taking the fib tool here for this leg. You can see here that this is pretty high up this price leg here. Took my first order here, and that is above the 50% level. General rules that you do not want to buy so high up the leg. I didn't realize this. I think I was blinded by my assumption that price would sweep this London high. So a better entry would have been here below the 50% level to go long. Another thing to consider is there are higher time frame POYs below that price can pull back to. Here is an example. We see an hourly fair value gap here and all this liquidity that price could take before the push up. That was another thing. And the last thing, coming back to the 15-minute, the previous day high was swept. And because the previous day high was swept, it is more likely that price could pull back. And so the important areas of improvement for this trade, I bought in a premium zone instead of a discount zone for that first trade. Second takeaway, be aware of higher time frame zones, especially if there is liquidity sitting above these zones like that hourly fair value gap. The third takeaway, be cautious when previous day highs and lows are swept because price can reverse or pull back after taking this liquidity. So I'm going to try to recreate it in TradingView. Also thought it could be helpful to show you how I'm currently keeping track of the trades I take. So on the 18th, I took 3 trades. And so I took 2 losses and a partial win. When I track my trades, I'll put the pair that the trade was taken on, the time the trade was filled, the date, how many pips stop losses, and then how many pips the target is. When I lose, I'll usually just put like negative 8.3 or whatever the stop loss is. And if it wins, I'll usually estimate it based on what the win was. If it's a partial win, I'll put less than the take profit. The full win, I'll put the full pips for the take profit. I don't know, that's kind of how I was recording it 2 years ago, so kind of out of habit. Then here I'll have my reasons for the trade, and then any areas of improvements or important notes I should be aware of. Then I'll record if this was a winner or a loser, the amount won or lost, the percentage of the account risk for that trade. Then I'll include screenshots here of the chart and MetaTrader 5 so that I'm always aware of the account balance. Coming over to the reasons for the trade, I had an overall bearish bias based on the daily chart. Coming over to TradingView so I can explain that more. So coming into the market, I marked out the previous day highs and lows. So these were the highs and lows marked for Tuesday. Then I also marked Monday's highs and lows. Also marked this daily fair value gap just to be aware of. My bias was bearish because price on Tuesday swept the high of Monday and closed within Monday's range. And there was also internal liquidity here for price to take. So now price could come for this low and to fill this internal liquidity. That was a narrative I had in my head. And dropping to the 15-minute chart. So coming back to the reasons, there were 15-minute relatively equal lows near the daily fair value gap for price to target, with price sweeping 15-minute liquidity into an hourly order block. This is how price looked like coming into my session. I marked that it was a 1-hour order block. So let me see here. Price was at an hourly order block here. And price swept higher time frame liquidity into this zone. We can see here, there are also high probability, relatively equal lows for price to take into the daily fair value gap. Dropping to the 15 minutes so you can see it a little clearer. Yeah, this is the 1-hour order block. This was the sweep of 15-minute liquidity into the zone, and these were the high probability, relatively equal lows for price to take. And so my entry was a 5-minute market structure shift and breaker block entry. Scrolling over here to the 5-minute chart, this is where the entry was. So you could see here that price stopped me out before coming to take the relatively equal lows and touch the daily fair value gap. And an area of improvement for this specific trade would be to place stop loss higher above this swing high to the left. So that's something to consider for future trades. Coming into the market, I had a bearish bias. I marked out the previous day highs and lows, and we can see that on Wednesday, price swept the Tuesday high as well as this daily swing high. So because price took this daily external liquidity, price could now potentially seek internal liquidity. And so I marked out this daily fair value gap as a potential target. Other potential targets for price to take would be the previous day low, as well as these lows into this daily fair value gap. And so that's the narrative I had in my head. Moving over to the original chart for these trades. So this was the first trade that I took here. I saw the sweep of 15-minute liquidity into this 15-minute POI that I marked out, as well as 15-minute SMT divergence between euro dollar and pound dollar. After I saw all this, I dropped to the 5-minute chart. And so here we can see that there was a market structure shift which left behind this breaker block and their value gap here. I was tagged in here, but because there was news, I started to overthink it. I ended up closing out the trade for a partial win of $54. If I had left the trade, it would have hit my take profit. Something that actually stood out to me as I was studying, ICT said that news moves can be used as a form of manipulation. It kind of changed how I see the news. So here I was scared looking at the reports that price would be bullish and would stop me out. And so I closed it out early, but ICT doesn't even look at past reports. Definitely an interesting perspective on news, that you can see it as manipulation, which could determine whether you hold or close out of trades early. So these are the rest of the trades that I took on the 19th. And if you recall, this was the day that I overtraded by a lot. A good cluster of them was during the silver bullet window, and being fully transparent, I was chasing silver bullet fair value gaps. Reflecting on it, I do think it was revenge trading to make up for this partial win. That's why there's so many different trades in many different directions. These aren't really worth going over because they were so emotional, but the biggest takeaway was that this set of trades was a result of this earlier trade. And so I was emotional after closing out early, and what I should have done was walk away. That would have been the smarter thing to do, but I didn't. And so I did take overall losses here. We 4 losses and 2 wins. So moving on to the last trade from week 6. Coming into the market, I had a bearish bias because price had swept the daily high here, taking external liquidity. It did not completely fill this daily internal liquidity here. Price had tapped it, but this portion of the fair value gap remained open. And so I was still bearish Something important to point out, based on candle range theory, one could also be bullish. On Thursday, price swept Wednesday's low here and then closed within the range, potentially going bullish to take Wednesday's high and possibly this daily high as well. And so that's another way one could have looked at it. It really depends on how you determine your bias. But for this first trade, on the 20th, I was bearish. Moving over to where I actually charted, it's a little messy, so I'll go ahead and switch over to a different chart. Coming into the market, this is what I saw. Price had just swept the previous day high. And because I had an overall bearish bias, I marked out potential areas where price could react. And so one potential area was this 15-minute fair value gap. You just see. So my POI was this 15-minute fair value gap here. This was liquidity that price could take into the zone. And then eventually, price swept 15-minute liquidity into the 15-minute fair value gap that I marked out. Price also left behind these high probability, relatively equal lows for price to target, with 15-minute liquidity being swept into my 15-minute POY with high probability, relatively equal lows below for price to take. I dropped down to potentially find an entry. Was looking on the 3-minute time frame. Price swept liquidity and had a market structure shift. You can see price stopped me out before coming to take the relatively equal lows and touching the daily fair value gap. An area of improvement for this trade would have been placing my stop loss above the swing high here. I'm watching ICT's 2024 mentorship, and he mentioned that price tends to move away from jagged areas. And so I guess I saw this area as quote unquote jagged. So I felt like it could be like a protected area since no reason for price to come back up here. If anything, the fair value gap was here. Of course, that was an assumption. And so safer stop loss would have been above the swing high. The reason why I took this, price had a strong reaction down, took this 15-minute liquidity into the daily fair value gap. Price swept liquidity within this daily fair value gap and then broke structure on the 5-minute. I actually placed 2 trades by accident, but it ended up going in my favor, so I kept them. After price swept liquidity and broke structure, I placed my entry as a breaker entry with my stop loss below here. Price came towards this market maker buy model target. So these were the trades from week 6. Now I can move on to the trades from week 7. This was my worst week of the challenge so far. I didn't win a single trade. I lost every single one. Overall, I was down about $414 for the week. I'm being fully transparent with you. Some of you may know I struggle with mental health, and not sure if this is just me, but one of the things that could really affect my depression is the weather. And it was raining all week where I live, and I was pretty depressed throughout the week. I'm really sharing this because I think it's interesting to see how my mental really affected my trades this week. It was a hard week for me, and I see it reflected in it because this was the worst week. So if you struggle with mental health like I do, it may be worth incorporating that into your trading plan. For me, it's kind of hard to avoid trading every time it's raining, but something I could do is, for the days that it is raining, reevaluate my mental and see if I should even be trading. And for days that it is raining, be aware and trade with extreme caution. And then for times when it's raining the whole week, it may be worth reducing my risk for the week. So if I do take losses, those losses can be minimized, or just take the whole week off entirely to back test, forward test, or study. So that's pretty much what I'm going to be taking more into consideration moving forward, is my mental and rainy days. Since this wasn't the best trading week, I'll talk more about my thought process, but really emphasize the areas of improvement and important takeaways. Starting with the trade on September 23rd, coming into the market, this is what I saw. I marked out the previous day high and low, Friday, as well as the Thursday high and low. We can see that price swept liquidity here, and it did have a reaction. However, we do see strong bullish momentum here on Thursday after price reacted to the daily order block. And then on Friday, we see that price swept the Thursday high, closed slightly above the close on Thursday. And I did mark out targets that price could come for, be this previous day high, this daily target here, and then this daily swing high here. So because price was bullish after reacting to the daily order block, and I saw all this liquidity up here, I did think price could come up to take it before coming down to seek internal liquidity below, such as this fair value gap. My bias was bullish on Monday. Switching over to the original chart. So this is how my chart looked like, pretty all over the place. And since these weren't the best trades, I'm more going to talk about what went wrong here. You can see here that I had all these levels marked out as potential targets for price. I was really expecting price to come up, take this London high, and then come take these targets as well. I was so married to that narrative that I tried really hard to catch that move up. And that's why you see 3 trades that lost. This was a divergence between euro dollar and pound dollar. But as you can see, this divergence shows that euro dollar was the weaker currency in terms of buying. So I shouldn't really have taken this as a good confluence. It's not really a great one, to be honest. I guess I took it because I figured that price would still be bullish, just not as strongly bullish. So you could kind of see that that was the case here, trying to catch the move up. This is where I realized that I just have too many entries for myself, too many to choose from. I believe this was like a breaker entry, and this was like a fair value gap entry, and this was a silver bullet entry. Like they were all pretty different, definitely different combinations of entries, and that's why I entered the trade or convinced myself to enter the trade. But as you can see, price pushed up, reacted to this 15-minute fair value gap, and retraced to this 15-minute inverse fair value gap before coming up. Price did eventually come to take these targets, but I was too early. It took those targets later in the week and not on Monday. Something that happened to me a lot was getting stopped out about like 5 pips early. The highest was 9 pips early about. I'm pretty sure it was during a time where the spreads are higher. So it looks like when I set my stop losses, I'm going to have to account for 5 extra pips. I'm not sure how I feel about that because when you're trading on the lower time frames, that could really hurt the risk to reward. I can even just do an example here. And so just going to one of the entries here, yeah, it's pretty messy. As you can see, I was chasing price. You can see that I was stopped out here and I placed my stop down here, and then I was stopped out here and I placed my stop down here. Something to consider is adding 5 extra pips to my stop. The only problem with this is that it can really hurt the risk to reward. So just as an example here, I placed a trade here, and let's say I add 5 extra pips. So it's like 17.5. So it definitely hurts the risk to reward. To get the risk to reward, I have to extend the target. And sometimes I don't think price is going to go that far. I think it's going to sweep something and then reverse. I might either have to just take the lower risk to reward and add the 5 pips. Another consideration was swing trading euro dollar. So maybe swing trading euro dollar and day trading futures. These are just things that are going on in my head. I'm not sure what I'm going to do, but I'm definitely keeping in mind that spread now because I've just been stopped out a lot, and I think I should probably take some active steps to address the pips. So I might swing trade euro dollar. I don't know in the future, but right now I'm still working on day trading it because that's how I started. Yeah, these pips are killing me. That's pretty much a takeaway. And the 24th at the same bias as on Monday with those liquidity targets above for price to take. And as you can see, it was early to the move. It ended up coming for the targets the day after on Tuesday. And I didn't want to get in on this move. And so dropping to the 5-minute, I can show you my entry. If I entered at this silver bullet for value gap that formed at 10:05, price came, it stopped me out before going to hit my take profit. Stop loss was down here. I was stopped out around here. Definitely need to keep in mind the pips when I'm setting my stop loss. But yeah, this one definitely hurt. Moving on to the trades from the 26th. Coming into the market, I had a bearish bias because price had just swept this daily swing high here. And so because price just took external liquidity, it could now seek internal liquidity. Did mark this daily fair value gap as potential area where price can come down to, but since that could be a while, more immediate targets I marked out were the previous day low and Wednesday's low here. Going to the original chart. So for this trade, I had marked out this 30-minute fair value gap here, and there was this liquidity, the London high, for price to take into that zone. Dropping to the 15-minute. So these were the relatively equal lows that I marked out as the target for price to take. Coming in, I did see that there was divergence between euro dollar and pound dollar near the 30-minute fair value gap. Here we could see that this was at 3:15, this was at 5:30, and then coming to pound, this was at 3:15 and 5:30 here. So because I saw this divergence, this showed that there was more selling pressure with euro dollar because of the lower high here. Price swept liquidity, swept the London high into the 30-minute fair value gap. And once that happened, I dropped to the 5-minute chart to find an entry. So I saw the sweep of liquidity. This was my market structure shift. After seeing this, I entered at the breaker block. Definitely wanted to get in on this trade. You can see I got stopped out before price came and hit my take profit. That was the loss I took on the 26th. There was another divergence that formed after I was stopped out. This is a better divergence to see when going bearish because second high is lower than the previous high and shows that euro dollar is the weaker currency. Yeah, this was loss that I took on the 26th. I believe I took another trade on the 26th. Okay, yeah, it took pretty much the same trade, just on a different layout. So this is the Capital Com chart. I think I just got a little emotional, so I tried to re-enter. I saw that price looked like it was coming higher, and so I closed out the trade early before price could stop me out for a full loss. So I took an almost $20 loss here. $19.62. And just something I forgot to mention on the previous chart, there were fair value gaps further up for price to come to. And so an example here was this 15-minute fair value gap. And I did see this, but because I saw the divergence, I was okay taking the trade at this zone. Moving over to the last trade from week 7, I still had a bearish bias for the same reason. Price had swept external liquidity. It could come down to take internal liquidity. These were the targets I marked out. High probability, relatively equal lows. I also marked out this order block and noticed that it swept liquidity before the strong move down. And noticed that there was divergence between Eurodollar and Pound Dollar at the zone. You could see here that this was formed at 230, and then this was formed at 645. And if we come to Pound, you see here it's 230, and this was formed at 630. And so because there was divergence at 15-minute POY, and it had swept liquidity before the move down, with high probability, relatively equal lows for price to take, I was bearish, dropping down to the 5-minute for the entry. I saw this market structure shift, entered here, but playing price forward, we see here that I was stopped out. This was a news move, and so I actually ended up losing more. Usually I risk about $65 per trade, and this one took me out for a $95 loss, so I was just done trading for today. Something I forgot to mention, something I have been doing, is watching how price reacts to fair value gaps. This was inspired by ICT's 2024 mentorship. So the midpoint of a fair value gap or inefficiency is called the consequent encroachment. Notice that ICT watches what price does around the consequent encroachment of fair value gaps. I'm still definitely very beginner, but I did notice that price was respecting the midpoint of this fair value gap and was even closing below it. So it was having trouble breaking past the consequent encroachment. I took that as a bearish signal, like something I want to look more into, signals and algorithmic order flow, but took that as price was struggling to close above the consequent encroachment. So it was showing bearish contention. And then that, with the divergence that I saw within the zone, is why I went bullish. But price reacted and stopped me out. And it was a news move, went in the completely opposite direction and took the liquidity up above. And you can see here, this is the 15-minute market maker buy model target with all these high probability, relatively equal lows for price to take above. Let me play it forward here. Took this 15-minute liquidity into this zone here. So we could see here that instead price actually reacted to this 15-minute inverse fair value gap with the news move and pushed up to take all of this liquidity into the 15-minute order block before coming down. That was the last trade I took for week 7. Definitely a handful of different types of trades from the past 2 weeks. A huge takeaway for me is that bias is so different than execution, and ICT touches on this. It's one thing to know where price is going. It's another thing to know when to enter to catch that move. Just reflecting, I definitely think my entry needs refining, and I noticed that I also don't have an exit strategy. An important skill with trading is to know when to enter and exit trades, and so I do need to refine my entry so I could have more precise entries, but also prevent unnecessary losses. Also to know when to exit a trade, so when it's not going in my favor. And so the way I'm going to form my exit strategy probably is going to be using the consequent encroachment of fair value gaps. So if I see that price disrespects a fair value gap that I'm looking at, like by closing above the consequent encroachment, something like that, I'll exit the trade. I don't know the exact rules yet, but I really want to refine the strategy to make it really rules-based so I don't have any room to interpret anything, honestly. I keep trading emotionally and I really want to combat that. So I'm going to take the steps that I outlined at the beginning of the video to hopefully stop trading so emotionally and to follow a very strict plan. And so that's what I'm going to be working on this week. I'm going to be taking a break from the Funded Challenge because I think I need one, refining and fine-tuning everything to make it very, very rules-based. Those are my next steps. But that's it for this video. If you found this video helpful, please like, comment, and subscribe, and I'll see you in the next one.